Okay, thank you very much, Francois. It's a pleasure to be here once again for this webinar series. The last one was in September after the series of central bank meetings, as we do as per usual. And we at the time we were discussing a number of data series that would be available for the next meeting. And since then, a lot has happened. A lot has taken place. And even though these meetings, and especially the Fed, the FOMC, has not provided the regular quarterly projections, the markets have been extremely active ever since. So, and especially active in a counter-trend manner. So it is extremely important that we take a look at why it is so, and how best to approach the current macro stance, and how to approach market timing going forward. It's not going to be easy, especially on the fixed income front and on the foreign exchange front, to be able to calibrate central bank guidance in the weeks ahead because of the cross currents. So we go straight into it. Okay, we go straight into it, and I will go back to the normative framework later on if we have time. Since November 1st, so what has happened? And as I said before, we're going to focus essentially on the Fed this time, because things have evolved in a big way. So what has taken place since the 1st of October, since the 1st of November, is essentially a huge battle of narratives. Going into the last FOMC, the third quarter GDP was the dominant narrative, and the strong labor market was de facto its corollary. What we've seen since is a shift where the market is focusing on the future GDP quarters and the softening of the labor market. And as we have produced in the last couple of weeks, we have produced a couple of notes. One on precisely that, the great loosening of the labor market that has started. So we have now a big battle raging between that loosening that has started, and as markets want to anticipate, they have already started to anticipate in a great way. And on the other front, the inflation narrative that is improving. We cannot deny that, and the CPI numbers of yesterday in the US and this morning in Europe and in the UK and in France have confirmed the trend. But these two narratives are somewhat conflicting, whereas they were aligned going into the November meeting. This confrontation of these two narratives is creating a lot of noise in the markets, in fixed income, with wide ranges, with a lot of volatility, and that volatility has been spreading to other asset classes, especially, in fact, triggering a very powerful rebound in risk assets over the last 2 weeks, and a somewhat large correction in the US dollar. So we are going to take a close look at this rotation in the narrative that has started and how to time it in order to be able to extract alpha from that transition without actually being too early and too contrarian with that transition. For us, the most important development over the last 2 weeks, since in fact since the November 1st FOMC, has been the rise of unemployment. We follow all the different classes of unemployment, but U3 in particular. U3 has risen to 3.9. And the fact that it's risen to 3.9 has triggered what we call the ImagineAlpha unemployment rate rule. This is a rule that is slightly different from another rule that is often referred to, which is the SAM rule, which looks in a similar way at the rise of unemployment rate from a low base. Our rule is slightly different. It borrows from quantitative analysis and technical analysis, but it's the same principle in concept, and it has been triggered. Now, the interesting thing about our rule is that its track record for timing NBER type recession dates has been absolutely perfect for the last 50 years. So each time that rule has triggered, a few months later, the NBER has come up with its dating of recession start with the same date. So without knowing, the market is trading the recession theme, or without knowing, the market was trading until a few days ago that recession theme. Now, of course, more and more people and market participants are going into that direction. This is creating a big headache for central banks, because the messaging of central banks has been on the sticky side of inflation and on the cautious side of inflation, because inflation was way too elevated and way too far away from target. So Bank of England, the ECB, the Fed, the speakers have been reaffirming that it was way too premature to talk about rate cuts. But over the last few days, rate cuts have really been on the table and in the discussions, in the debate on the market side. And that tension between the central bank's guidance and desire to hold for as long as possible, and the market's willingness to already anticipate the next turn of the cycle, is creating this volatility that we want to take advantage of. So here is an illustration of the change since November 1st. At that time, the first hint of a rate cut was priced for June. And as of yesterday, the odds had been moving all the way up to the second quarter, early in the second quarter. So, or earlier in the second quarter. So that migration of interest rate cut expectations is should not be, in fact, a surprise. It's a bit aggressive, but should not be a surprise. And it's already pre-positioning, you could say, in fact, front-running the central banks in their shift of guidance. In fact, the market is already in a position to play the pivot of early 2019, if you remember. And we will see that our approach to market timing is extremely useful to avoid the pitfalls of too early an entry. But definitely, when the signal will be triggered, definitely it will pay off to jump on board the trend. So at this time, we are observing noise more than signal in the market gyrations in fixed income. And that noise, those gyrations, are noisy because they are not in sync with central bank guidance. So what will make the central bank guidance really is change is whether it is whether or it is when the data will start to show that the unemployment rate rule that has triggered a cycle turn, an inflection point in the labor market dynamics, is really paying off and is really in bringing a strong loosening of the labor market. So we're asking, why has this change been so rapid on the fixed income side, on the interest rate side, and the collateral short squeeze on the risk asset side? The reason has been, of course, over the last 24 hours, it was in gestation, but over the last 24 hours, it has been much more blatant. The CPI, the chart on the left, the US core CPI, came out at 0.2, so well below expectations. The incline of the decline of the path for core CPI going into next year, that's the black line on the left chart, is clear. The destination is around 2.5% for core CPI by mid-year, and 2.5% core CPI by mid-year next year is about consistent with a core PCE that will be closer, much closer to 2 as well. So or on the way down to 2. This morning, French CPI came out. The green line on the middle chart is the 6 months average. It's annualizing around 1.6. So central bankers prefer to annualize the 6 months, certainly in some in the US. So we take that benchmark, and we see that French CPI is normalizing, coming back to trend, which is the yellow moving average, and below 2, which is a strong positive. And the UK core this morning came out slightly higher, okay, well above. It's 4.4, so it's not mission accomplished by all means, but it's on the way in the right direction. And in fact, in the UK, everything but core and the services is already there. So of course there are the base effects. There is the impact of the energy. So that's why the Bank of England is not going to let go of the current monetary stance and the restrictive position, but the market wants to see the other side of the cycle, and it can be understood. Now, it might be way too early, and that's why we have to be patient with the macro timing, and overlay on top of it the market timing that will give us much cleaner signals. Here we have a raw signal that things are improving, but we want to have a clean signal with our market timing overlay. So in fact, in terms of projections, a central banker would be saying, well, what has really changed since last time? 0.1% of on the unemployment rate. That's what has changed. But otherwise, on the core PCE for the Fed, not much has changed. In the SCP, in the projections in September, it was projected that the average monthlies into year-end would be at 0.29% month on month. And for September, we got 0.3, so just in line. And on the chart on the right, we see that the incline of the core PCE has not really changed drastically from September. It's a gentle decline all the way down to 2.5% by mid-year. Now, I want to stress a very important point, which is that as core CPI is declining, real rates will start to widen even further, and that we think that that breaking below 3% would be a first psychological step that will unlock, in fact, the guidance towards a more dovish one. So the question for analysts, for strategists, and markets in general is to try to be able to time that move through 3, because as you understand, moving below 3 would open up for some pivoting of the guidance, and that's exactly what the market is doing now. The real rates have moved. The real Fed funds rate has moved to 2.5, around 2.5%. With core PCE moving below 3, that level of real rates will still be there at a time when the economy will be probably slowing, and that would be probably a bit too much. So without sounding the all clear on inflation, a little bit of loosening of the guidance could take place at that time. From what we have seen so far, core PCE is projected to cross through the 3% level in March. So around March, April, so end of Q1, beginning of Q2, that's when really at this time we are looking for that inflection. And that's why markets that are looking way beyond Q1 or Q2 next year have already started to anticipate. We also have seen in the last 24 hours some analysts come up with projections of 250 basis points rate cuts. Those scenarios, of course, go way beyond the normalization. They are pricing something much more severe. And we will see that, in fact, it's a big bet on the lifting of the unemployment rate and on the implications of the triggering of the unemployment rate rule. So the great loosening of the labor market, starting with the US, but similar situations are observed in other countries. For example, in the UK, it's starting to look like very similar to the US. It's not a surprise. So now we're focusing on the situation in the US, and as you can see on the chart on the left, which was also part of our publication in the last couple of weeks. The unemployment rate has embarked on the 7th upcycle in the last 50 years. So that is an important. This is an extremely important development. It has framed price action in the bond market for the last 2 weeks, since Friday, 3rd of November. And it is going to continue in the next few months because these things do not happen in a vacuum. Usually they carry momentum of their own, and we will see that that momentum will be, there is no reason to doubt that this time is different. So the important thing is that, and that is the chart on the right, that as I was mentioning earlier, the colored dates on the x-axis on the right chart are the dates of our unemployment rate rule crossing the alert line, which is the orange line, and the shaded areas are the NBER recession dates. Overlaid on that, we have the Fed funds, and we see that, in fact, the inflection points of monetary policy cycles have often, in fact, always accompanied that triggering of the rule. So why is it that that rule is so important? Well, that rule is important because, as I said, once the dynamic is launched, it feeds on itself and it catches momentum of its own. It's an important, extremely important rule and extremely important signal. Here we have 4 tables. On the top left table, the unemployment rate first, we are measuring the change of an employment rate once the rule has been triggered. And we will exclude the March 2020 episode because of the nature of the external shock. So we will focus, and that is what has been, what is in underlined in yellow, on the results of the other episodes. And we see that the unemployment rate rose in all of the ensuing in all the episodes and over all the ensuing periods after the triggering of the signal, which is a 100% track record for that rule, from 3 months onward to 24 months onward. So and one could explain that by, in fact, the lagged effects of monetary policy. In fact, the triggering of the rule is simply the acknowledgement that in the data, the effects of the lagged effects of the tightening of monetary policy into very restrictive area is starting to bearing fruit. So that's the box on the top left of that screen. On the top right of the screen is the number of unemployed. It's important because obviously in the next 12 months, there are a few events going on, especially in the US, and the status of the labor market will have a very strong implication on what could go on, what will happen during that election year. Now, history is not too kind with the unemployed and the total number of unemployed. We see that, of course, if the unemployment rate is rising, the number of unemployed is, of course, rising. Here, what we wanted to look at is the quantities. And we see that across events, it's about 1 million jobs lost over 6 months in the period of 6 months following the triggering of the signal. So that means that, in fact, the loosening is going to take a lot more momentum going into well, 6 months after October, which is sometime in the beginning of at the beginning of October, in the middle of Q2. So, and hence the reason for the pricing, the market pricing, much more dovish guidance and policy anticipations around that time. That's precisely because the deterioration of the labor market is expected to really gain traction at that time. In terms of market triggers and policy adjustment triggers, very important, of course. Non-farm payrolls, that's the box at the bottom left of that screen. What we see is that the non-farm payrolls 3 months after the triggering of the signal, in all circumstances, have been negative 3 months and 6 months after the triggering of the signal. So in concrete terms, it means that the odds for a negative payroll print on the employment Friday, beginning of each month, is going to rise exponentially over the next 3 months. So the most likely timing for the first negative payroll will be January, payroll of January, which will be published in February. So we've got to keep that in mind, because the volatility of markets and the signal of markets around January, between January and the beginning of February, will be very very important indeed. And the corollary of the signaling of the loosening of the labor market through a negative payroll print is the Fed funds. And here, history, and again, history is just for guidance. It doesn't really mean that we are going to have a replication of the past episodes, but that is, this historical context is giving us food for thought. And what we can see is that associated with the rise of the total number of unemployed, a negative payroll print sometime in January or February, and that would possibly trigger a rate cut. So the bottom right table shows the change of Fed funds in the ensuing months after the triggering of the unemployment rate rule. And we see that the median has been around 200 basis points to 225 basis points. Of course, this time around, things are different. So take these levels and these numbers with the appropriate context, within the appropriate context. The current situation might turn out to be slightly different in the way events evolve, but if the rule is confirmed by further increase of the unemployment rate, and a negative payroll comes up sometime in the next 3 months, the beginning of the inflection of the interest rate cycle will be much earlier than anticipated. And going back to what I said earlier about some analysts already projecting about 200 and 250 basis points of rate cuts within the next 12 months, this is precisely what they probably have in mind. Which is in fact an acceleration of the dynamics of the loosening according to or along the lines of historical precedents. So it's a big so this is these three tables are really at the core of or go a long way in explaining what is taking place in the market for the last 2 weeks. Okay, the combination, as you can understand, of the triggering of the rule and of a better path towards levels of inflation that will allow that will give central bankers a bit of comfort in adapting their guidance is really what is has been moving markets. Now, the current situation has got its own dynamic. I don't know, Francois, if I should go maybe open a parenthesis of 2 to 3 minutes to discuss the normative framework, or we do that later on, or in another webinar. But suffice to say, at this moment, that maybe just briefly, I will mention this, that as per what we are looking on the right chart, the monetary policy at this moment in time is extremely restrictive compared with what is supposed to be neutral. Now, there is a huge debate on the usefulness of the neutral rate, and at ImagineAlpha we have we believe the neutral rate is a useful tool because we have found a relationship between the neutral rate and the correct or a normalized rate for nominal Fed funds. Probably that we are a bit ahead of the debate that is taking place in academia, but we find it useful because we have found how to extract information to define what is the level of Fed funds that is the right level in a normative way. On the left-hand chart, it's the dark blue line, and that dark blue line, without going into the details, is currently sitting at 2.5% and influenced by demography and long-term trends. That line is going to decline all the way down to 1.75 by the end of the decade. So for us, nominal neutrality is around 2.5, and because of the local effect of extremely proactive fiscal policies, we understand why the nominal Fed funds have to be much above that neutral rate today, just because of the fiscal dominance. But as soon as that fiscal dominance or that fiscal stimulation is removed, it is quite likely that interest rates or that the economy will move again in sync with its long-term path or pace, and that pace is not a pace that we used to see in the late 1970s or in the early 1980s. It's a pace that is more in line with what we have seen in the since 2000, and in fact lower than that. So a normalization will mean a return of interest rates in 2026, 2027 towards 2.5. Okay, so we have said that a huge, a very big event has taken place on the macro front in October with this unemployment rate rule, that inflation is in the right direction, that central bankers are resisting the calls from the markets at this point because they are data dependent, and that so far the loosening has not been big enough. We understand that. So how we go
Carlos, a very
yes,
brief question for you, because you say they are data dependent.
Yes.
Can you confirm that the main data is something you highlighted before? So the labor market is key, and it's 80% or 100% of the data they need to make decisions, more than inflation fact numbers. What are your views on that?
Okay, so in normal times, it would be, for the Fed, it would be 50-50, unemployment, or the maximum employment leg, and the inflation target. But that 50-50 is we are in a situation where where the narrative is transiting from a 100% inflation, zero on employment, because the labor market was extremely tight, so all the focus was on inflation, and we are transiting with this signal on the unemployment rate. We are transiting from 100-0 towards a more classical 50-50. In fact, we might be, I don't know, 2/3 inflation, 1/3 employment at this point. Okay, it's going to go to 50-50, and at that point, when really the threat to the employment part of the mandate will be more evident, then there will be an adjustment of guidance and policy. Not the least because the institution wants to preserve its independence, and that there will likely be calls from many quarters to do something about a deteriorating situation, or loosening, a too fast loosening of the employment or of the labor market during a critical year in 2024. So now that we have set the macro stage, we are looking at market timing. So that is what we do. That is what we do in a very peculiar way, very distinct way, successful way at ImagineAlpha, and we want to show you how we would like to approach that shift in the macro with market signals that will validate or not the ongoing shift in the narrative. So first, just a quick word on what is going on in terms of that shift. We put those charts on our website, ImagineAlpha.net. The chart on the left here is in orange, the volatility. So you can see that for the next 12 to 24 months, we are expecting a rise in volatility. That is an important point, because that will reduce the quality of returns for risk assets. So you could have risk assets performing in a neutral manner, let's say, not necessarily rallying aggressively, but the volatility that will be associated with that performance will likely be much greater in the next 12 months due to the lagged effects of monetary policy. Volatility is responding with a lag to that monetary policy, and 2024 will likely be a year of higher volatility because of those lagged effects. So the intensity of the great loosening will matter a great deal because it will change the way central banks position their guidance and the way the markets decide to price the cost of capital to the economy. We like to use market signals in the higher time frames, so monthly or quarterly series, for that type of macro shift, because those signals are less high frequency and they are sticky. So at this point in time, we are looking for a shift in markets that is much bigger than the 2019 pivot that took place in the first quarter of 2019. That was the end of the previous hiking cycle, because at the time, the unemployment rate was not affected by that pivot. Here we have the unemployment rate being affected by the shift. So we are expecting that at some point, all points on the yield curve, on the US yield curve, will be signaling downtrends in yields. The problem is over timing of that event. And again, we're back to the tension between central bank and the market, between inflation and the labor market. At this point in time, we have seen the early changes to portfolio allocations, but we have not seen the global portfolio allocations really move into that theme yet. Okay, and that will take place eventually when the data deteriorates, or when the great loosening becomes more apparent, sometime in the beginning of 2024, or between now and the beginning of 2024. And we are monitoring the following levels. In order to validate the big shift, the 2-year needs to trade consistently below 475. It's not far. It's 482 right now. But we have seen that during the SVB episode at the beginning of 2023, it traded through the level, but it didn't sustain the levels below on the left chart, below the red line on the left chart. Okay, so that's what we mean when we say sustainably. It needs to move below, the 2-year yield needs to move below 475 and stay below 475 to really give us the right timing for the pivot. For the 5-year, the level is around 430, same logic. And you see that at the beginning of 2019, both the 2 and the 5-year went through the level, sustained through the level, and spent all year long declining, way before, in fact, the Fed cut rates in the summer. So there is plenty of time to jump on board. It pays to be patient, especially when the central banks don't want to give you the pivoting signal. And then, of course, at the back end of the curve, very important, for the 10-year and the 30-year, the levels are around 430 and 439 for the 30-year. So between the 5-year at 430 and the 10-year at 430 as well, and the 30-year at 439, we can see that in fact there is a sort of consensus among the the market triggers that 430 is the pivotal area along the yield curve. Once that level is broken, one can expect that everything goes with it. That probably we will have close to zero non-farm payrolls, probably an employment rate above 4.1, 4.2, and probably a shift in the guidance, and probably pricing more than 100 basis points in the 1 year of Fed fund cuts. But at this point in time, what we are seeing in terms of the move in rates is a lot of volatility, shuffling of portfolios, squaring of positions, but not yet really enough substance to give us the all clear on the pivot. We know that the fundamentals are about to change, are in the process of changing, and that's the signal that we received from the unemployment rate rule. But the evidence is yet to be given by the data, and the data dependency is giving central banks time to play. Voilà, François. That is it for me. And if you want to have more engagement on all these views, and the better way to trade inside those larger trends, we will be more than happy to discuss that with you.